When considering the future of a global reserve currency, it's crucial to understand that its value won't collapse in the same way that currencies of hyperinflated economies do. For example, while the Venezuelan stock market might seem to perform well in Bolivar terms, it's collapsing in dollar terms due to hyperinflation and currency debasement. This is not the likely scenario for a global reserve currency. The outcome will be shaped by a combination of factors, including GDP growth, productivity growth, and debt growth. Debt growth is largely curtailed as we refocused on servicing existing debts rather than accumulating new ones. Meanwhile, population growth is negative or stagnant in many advanced economies, impacting overall economic growth. The real answer to these challenges lies in advancements in AI and robotics, which promise to drive productivity. Productivity is essentially the output per unit of energy, such as electricity. As we invest in technology to increase efficiency and lower energy costs, we can counteract some of the negative trends.
When we talk about the future of a global reserve currency, it's important to distinguish it from the currencies of hyperinflated economies. Take Venezuela, for example. The stock market might look strong in Bolivar terms, but in dollar terms, it's collapsing due to severe currency debasement. This kind of collapse is not the likely outcome for a global reserve currency like the US dollar. Instead, the future trajectory of such a currency will be influenced by a mix of GDP growth, productivity growth, and debt management. Currently, debt growth is largely halted as economies focus on servicing existing debts rather than taking on new ones. Additionally, population growth is declining in many developed countries, which can slow down economic expansion. The key to addressing these challenges lies in advancements in AI and robotics, which have the potential to drive significant productivity gains. Productivity essentially measures how much output is generated per unit of energy, such as electricity. If we think of electricity costs as a crucial factor, improving productivity means enhancing how efficiently we use energy. European nations, for instance, are investing heavily in green energy technologies. While some might criticize these investments as costly, the main goal is to reduce the cost of electricity. By achieving lower energy costs and harnessing technological advancements, these countries aim to boost productivity and support economic growth, despite challenges like demographic shifts and high debt levels.
Subscribe our channel and press the bell button to get our video notification. And like the video.
Intricate connections between historical events and current issues often go unnoticed. People tend to get frustrated with each other and the rising polarization in politics, but many don't realize that these patterns have deep historical roots. As you pointed out, the origins of these issues likely trace back over 200 years, possibly even further. This historical thread weaves through numerous events and crises, reflecting long-standing dynamics that shape our present. For instance, the French Revolution and other major upheavals from the past have set in motion complex economic and political developments that continue to influence today's world. Even significant moments like the 1929 stock market crash are part of this broader historical continuum. These events are not isolated incidents, but part of a larger narrative that has evolved over centuries. Understanding this historical context helps us grasp the deeper connections between past and present issues, revealing that today, as challenges are often echoes of long-standing trends and patterns. Recognizing these links can offer valuable insights into how we address current problems and navigate the complexities of our time.
The intricate connections between historical events and today's issues often go unnoticed, leading to frustration and rising polarization in politics. Many people don't realize that these patterns have deep historical roots. As you mentioned, the origins of these challenges likely extend back over 200 years, possibly even further. This historical thread interweaves through numerous events and crises, reflecting long-standing dynamics that shape our current reality. For example, events like the French Revolution and other major upheavals from the past have set in motion complex economic and political developments that continue to influence the world today. The repercussions of these events are still felt, as they laid the groundwork for many of the systems and structures we interact with now. Similarly, significant moments such as the 1929 stock market crash are part of this broader historical continuum. These events were not isolated incidents, but rather integral pieces of a larger narrative that has evolved over centuries. Understanding this historical context allows us to see how today's challenges are often echoes of long-standing trends and patterns. By recognizing these connections, we gain valuable insights into how to address current problems and navigate the complexities of our time. It highlights that many of the issues we face today are not new, but are rather the continuation of historical dynamics. This perspective can help us approach modern challenges with a deeper understanding of their roots and potential solutions.
Every year, if earnings growth is around 1.5%, asset values are increasing by 10%. This dynamic means that as time goes on, you can afford fewer and fewer assets with the same amount of money. An asset represents future deferred consumption, whether it's for your retirement, your children's future, or other long-term goals. It's essentially a way to save and grow wealth to protect your future self. If assets grow sufficiently, you can potentially accumulate significant wealth. The problem is that everyone's future self is getting poorer in real terms. As assets become more expensive each year, it becomes harder to accumulate them. Millennials and younger generations are particularly feeling this squeeze, as they're finding it increasingly difficult to buy a home or invest in assets like the S&P 500. The rising cost of assets relative to earnings is creating a challenging and frustrating situation, making it harder for younger people to build wealth and secure their financial future. This growing disparity highlights the broader issue of asset inflation and its impact on long-term financial stability.
Every year, as earnings grow at about 1.5%, asset values are increasing at a rate of 10%. This means that, over time, the same amount of money buys fewer assets. An asset, in this context, represents future deferred consumption, whether it's for your retirement, your children's education, or other long-term needs. Essentially, assets are a way to save and grow wealth, to ensure that your future self is financially protected. The growing disparity between earnings and asset values creates a significant problem. As assets become more expensive each year, it becomes increasingly difficult to afford them. This means that in real terms, people's ability to accumulate wealth is diminishing. For millennials and younger generations, this is particularly challenging. Many are discovering that they can't afford to buy homes or invest in assets like the S&P 500 as easily as previous generations did. The rising cost of assets relative to earnings is leading to a situation where younger people are struggling to build financial security. This disparity between the cost of assets and income growth is not just a minor issue, it's a significant and growing problem that impacts their ability to save and invest for the future. The situation is increasingly frustrating as these individuals face a financial environment where the goalposts keep moving further away, making it more difficult to achieve long-term financial stability and prosperity.
Subscribe our channel and press the bell button to get our video notification. And like the video.